everyone, and welcome to the February webinar Wednesday from Pearl Planning. It's Melissa Joy here, and I am thrilled to be talking to you about under the radar, overlooked tips and tricks for your investment portfolio. This is a webinar that is close to my heart because I see so many investment portfolios from new clients coming in or from outside places, and I feel like it's really important to talk about some of the most modern strategies, some basics, and some advanced knowledge. And I see these types of things and talk to people one-on-one about them all the time, but we don't always set aside time to have these discussions in a group setting or just go over and lay things out in a longer format. So I am thrilled to be sharing with you. And without further ado, we will get started. So when I talk to you about this topic, I want you to know that, many people feel like perhaps I should know more. And there's a lot of either anxiety when it comes to money. In fact, more than 40% of families say they're not confident, especially wealthy families, with managing their investments for wealth. And so you are not alone if you think this is a topic I need to learn more about. There's a little bit of imposter syndrome sometimes with families. And so we want to make sure that we're breaking down some of those barriers and increasing your confidence and knowledge. I'm Melissa Joy. I'm founder of Pearl Planning, and we are a financial planning and wealth management firm located in Dexter, Michigan, serving clients around the country. And as we get started, here is our agenda. First, we want to say and kind of set the table by saying why this matters. And then we're going to do some investment basic courses. These are items that, I think probably every investor may have heard of over time, but it cannot hurt to re-emphasize some of the fundamentals of investing so that you remember as you go through the process of investing, the things that help investors to be successful. We'll remind you of some common mistakes and how to avoid them. And then we'll really get into an advanced kind of educational structure and format where we go over one of the hardest areas of investing, which is what to do when you start to have cash piling up and kind of run out of space that feels easy to make your investment decisions, often retirement accounts. And so how to navigate taxable investments or investments outside of that easy zone. And then we'll wrap up and summarize by talking about times when it really makes sense to do it yourself when it comes to investing and times when it may make sense to work with a professional. And we'll even talk about when you're working with a professional, when it may make sense to make a change. Okay, let's kick it off. I really intend this webinar to be both for our clients who work here at Pearl Planning to be reminded of what we do and why we think our process is important and, very relevant to modern investing times for financial planning clients, as well as for those who aren't as familiar with Pearl Planning, just to kind of tick through some of the things that we think are important, some of the things that we see that people may be missing, so that you can feel like you have some information to go back and review within your investments. But when we think about investing, it's not just these letters alone. It really is your investments being tied to your goals in your life. We think that the most important way for personal finance to be as an investor is to also have a financial plan. That really allows you to have the resilience to understand things within your financial plan and then have the resources, your investments working on your behalf to achieve your goals. Investments can be a pyramid, and the base of that pyramid, as we just said, are your goals and financial plan. It sounds like you may be putting the cart before the horse when you're like, hey, Melissa, just get to it. I want to talk about my accounts. But we really think that fundamentals of knowing where you're going and why can build up to the area that we're going to spend most of our conversation in today, which is the decisions around the mix of stocks and bonds that you have, or perhaps where you're putting accounts. We don't think there's as much value at that top of the pyramid on your choices of buy fund X or stock Y. And so we're really going to be focusing today, not on the financial planning. I just wanted to remind you that you need those basic pillars and the foundation of the pyramid. We're going to be focusing in the middle. So let's start with the basics, some basic tips and tricks. The number one, and I think it is so critical to remind yourself of this all the time. It needs to be, kind of the verse that you tell yourself day to day when it comes to investing or whenever you think about investing is it pays to be patient and it also pays to be glass half full. That might sound a little too Pollyanna-ish when it comes to those scary markets out there when around the corner any day could be a down day or a bear market. But over time, statistics show that market performance tends to be a coin toss day to day. A little more than half are up and a little less than half are down. But you'd feel more like going to the casino and going to a roulette table than necessarily feeling like you have good odds with you. But as you add over time and add months to years to even decades, which is what most of us will need when it comes to either saving for education, saving for retirement, or saving for kind of midterm goals, then that casino turns into a much more powerful, kind of predictable and statistically glass half full result. So over decades, 94% of the time, markets as measured by the S&P 500 tend to be positive, and there are very few time periods where performance is negative. And so we need to remind ourselves of that because it can be so easy to see everything that's doom and gloom when it comes to either markets or life. And let's be frank, when life seems gloomy, so do markets. But it really doesn't pay to have that just fundamental pessimism all the time or just feel like, the rain showers are always there. In fact, when you look over longer periods of time and you compare, for example, the returns of cash, in this case, I would use cash as basically the returns of the light blue. You can see it almost to the bottom, right above inflation. That is your short-term bonds, which could be a nice substitute, when looking at cash. It's not exactly the same, but quite similar. And then you see the price of gold in orange. That's often for people that are super glass half empty, something that people would like to add. I'd say a little goes a long way there. And then going on up, you see the returns of bonds. And then in green, you see the returns of small companies. And in purple, you see the returns of big companies in the United States. So over time, there's a lot of reasons. In gray, you can see 4 recessions over the last 40 years, but there's a lot of reasons to feel skeptical about investments in markets. And yet, in spite of all of the reasons to say no to investing, there are compelling reasons over time and history why investing does make sense, especially when you link back to the things you want to accomplish and do in life. So we like to tell people from a narrative perspective, your financial plan and lessons from history in the market really matter. What don't matter are short-term predictions, headlines that can be a distraction or even, kind of deception in terms of what you should be focusing on. And then the daily movements of the markets. Again, it's a coin toss any given day. You're looking more for longer term trends and for relying upon the lessons of history, not for prediction, but for probabilities. And frankly, when you look at history, there's a lot to be optimistic about. Not to say that you should, lose all, kind of perception of risk, and certainly you need to be careful and have investment decisions that fit with the risk perspective that's appropriate for you, your life, and your needs. But I do think it's really important to remember what matters, which, the things coming at us day to day, whether it's in the newspaper, on your internet headlines, or nowadays in TikTok, frankly, those things need to be put in their place, which is low on the priority list of where you should act when it comes to investing. So I think as we've kind of laid that foundation of things that really matter, patience pays off. Optimism is not a deficit when it comes to investing or disability. It's actually can be quite powerful. Let's talk about some mistakes that can really get you behind, mistakes that matter. One of those mistakes sometimes, and this is from really smart people, I see investment portfolios where they made the right decisions about getting money into accounts. But then, it feels like the job is done, but they didn't actually get that money invested in anything but the default, which is often cash. And I've used this statistic from last summer in August 2023, more than 10% of cash or of accounts at Charles Schwab was being held in cash. So big miss if you really intended to be invested. And we see this all the time. You made a little Roth contribution, and then oops, I forgot to pick a fund. I didn't really know it wasn't defaulted like it is in my 401k plan. So go through your statements, do a little audit, make sure that you have everything that you want to have invested. And that's not to say that there isn't a value with having cash reserves. So we certainly can understand why that might be appropriate, especially if you're withdrawing or you're using an investment account for your emergency reserves. But if the money is intended to be longer term and invested, make sure it's doing what you intend it to do. Another, kind of common pitfall is that people can really let their emotions play out in their investment decisions. And we think, and we use this often if you've listened to our other webinars, that emojis really tell the full story. So look at these emojis going from a, kind of middle market where you're just like, hey, I'm cool, to an exuberant wild market where everything feels like it's coming up roses and you really want to, you feel like your friends are making more money than you. Why am I missing out? So you put the pedal to the metal to, things are going down. And then you can feel even despondent or depressed or praying when it comes to a situation where, the roller coaster is on the downswing and you don't know when things are going to stop going down. Unfortunately, making risky decisions at the top and buying high, or making decisions to hunker down at the bottom and sell at lows is kind of a repeatable process that is really easy to fall into. And so we like to remind people that while you may be feeling those emotions, that it is important to kind of put on your game face, your poker face, and not make moves based on the swings or roller coaster of natural market cycles. And so this is a great visual reminder of what's important and what needs to be done. So here's what happens though, if you do make those decisions and you make the decision, for example, to sell low. We're going to use a recent example. It feels like a long time ago, but just a few years ago, of course, March of 2020, markets went way down because the world shut down due to COVID. And in fact, a dollar turned into 80 cents quite quickly. And with that, and that's for a diversified portfolio of 60% stocks and 40% bonds, kind of a portfolio that's built for retirees that isn't supposed to go wrong all the time. So let's say you retired in January and you're bopping along, clipping your coupons, paying yourself out of your portfolio. You get to the point in time where your $1 million turned into $800,000. And you're calling up your advisor or broker and saying, I am out of here. Please get me into cash because I don't know what is coming next. And I just need to have some safety and control over my money. Well, let's say you sit out for a few months because you're just waiting to see, like, hopefully there's a vaccine or something. I'm going to just sit it out for a minute. Sitting it out for just a minute and then going back into the same portfolio could leave you even being behind where you started for as long as through last summer, or maybe even until now. Also, just staying in cash for the whole time, a big challenge that doesn't work well either. But if you had stayed invested, you would have made up and gotten above that hurdle of where you started for that year of 2020 before the end of 2020. And so that's a great visual example of a real life example where people could have chosen and did choose in many cases to go into cash. I really look at my own personal batting average as an investment advisor, as someone who works with people on their investment decisions, for keeping people invested with the process that fits with their risk so that they don't have these moments where they end up getting out and not knowing when to get back in. So looking on the left and right here, this is just another visual to remind you that there are always excuses to not feel comfortable with investing. Maybe the market's too high and then it goes down and you're like waiting for it to go lower. You want the perfect down moment. And when the market's coming back up, again, you're looking for that pullback. This can go on and on repeat. And so what we remind people is, instead of trying to pick the perfect moment, use your process to indicate when you should be investing. And then in reality, we've just put some examples. I know they're small and dark, but you can probably imagine some of them all the examples of why you shouldn't invest. And frankly, we could have many, many more than that, but you can see COVID-19, you can see record inflation more recently. You can see, I remember, nuclear contamination in Japan due to a tsunami, the liquidity crisis in Asian securities in the late 90s. This list can go on. And there's always a reason to sell. And yet, over time, the process of staying invested, staying patient, and sticking with the process tends to pay off. Past performance, of course, does not predict future returns, but I can tell you in an even more concrete fashion, using this very unfair example, but real world example, that costs also do matter. So this is another really important thing to consider. Over my career, which spans more than 20 years, the cost structure of investments has gone way, way down. And I think that's a big win for investors. I used an extreme example in this case. I just took a Google search of most expensive S&P 500 funds. Came right up. I don't know if it's the most expensive, but gosh, 2.36% to pay per year to get exposure to the S&P 500. Part of that payment goes to the broker who sold those investments because they're C shares. That is really darn expensive. Now I compared it to the biggest open-end mutual fund, the least cost open-end mutual fund in this case it's Fidelity's S&P 500 fund, and it costs 0.02. It's actually less than that if you round out and add the third digit to the cost. And so, a huge discrepancy in terms of the cost. It doesn't sound that much. I mean, when you say it in nominal dollars, you're like, okay, what's the difference in 2%? Well, in this case, we have returns going over a 10-year period, expensive versus cheap. Expensive is in purple and cheap is in blue, in orange. And, $10,000 turns into $32,000 with the right choice, the least expensive option, versus $10,000 goes into $25,000, a $7,000 delta, approximately, if you choose the more expensive option. Those are real dollars. They can really make a difference in retirement. And, that isn't to say that the very least expensive option is always the perfect choice, but when in doubt, choose to be less expensive. The way we incorporate this into our portfolio management style is I always am challenging our investment committee to make our portfolios and models less expensive over time. We're looking for options that could cost less. And then when we do choose to pay more for something that we think we couldn't replace with a less costly option, then we, continue to kind of ding the process of that investment and challenge ourselves to find something cheaper if it makes sense. And I think that really, this is a stark example, but you can pick up nickels and dimes and pennies along the way when you're paying attention to your costs. A lot of people may have a legacy portfolio. So, I described 20 years ago, it was way different. I see investment portfolios that were set up 20 years ago, and the broker or advisor hasn't really made the phone call to make things different over time. Maybe they're using kind of old school mutual funds and investment portfolios, and that can result in carrying more expensive legacy costs. It doesn't always make sense. You don't need to hang up from this webinar and then immediately go and sell everything, especially if you have taxable investments. There may be a tax cost associated, but we do have strategies and ways to get you kind of converted over to less expensive over time if you're sitting with a tax situation that would not be perfect to do everything at once. Okay, let's talk about some advanced strategies. We promised we would, and here we go. I hope that for those of you that are geeky like me, that you enjoy this, but we'll try to keep it approachable for everyone involved. Of course, if you don't understand a portion of our conversation, first of all, I want you to know that it's important that if you're listening in, that you can reach out to us and ask follow-up questions, because sometimes we go straight to jargon, and we try not to. And I'm really trying to use visuals to kind of hammer this home. But if you need clarification on any point, because I'm moving quickly and trying to pack a lot into a short period of time, I would be happy to have a follow-up conversation with you. Okay, so a lot of times it feels from a psychological perspective, they're kind of hitting the danger zone. It's a good danger zone, but when you start to have more cash on hand, people become reluctant to make a next step because there's sometimes if they're really, adding as much as they can to their retirement accounts, they don't know where to go next. And so this is just, let's have a minute for conversation of some of the options and kind of a checklist of what you should consider. First, I think it's really helpful for you to have targets on the amount of cash that you should own. It's really nice now because we're sitting in 2024 and you actually get paid a yield on your cash if you put it in the right type of account, like a high yield savings account. So, hey, that's great. You're paying yourself as you go instead of letting the bank make the money or just making no money because there's no interest. But let's say that you have some higher expenses, you want to be able to, for example, cover a year's worth of mortgage or cover 6 to 12 months of living expenses if you're living off of one income. Whatever the case may be, and we often have these types of conversations, I would say part of it is, kind of more of an equation, and part of it is a preference based on the way people feel when they have cash. Some people have just been told you should invest everything, and they like to carry lower cash, especially if they're great investors. That can be okay because there are other backstops. Other people really feel more comfortable, and that's an important thing to share with your financial planner when you have more cash. Okay, so what's your target? Let's say it's $50,000. Well, if you go down to $49,000, do you need to stop everything and put it back to 50? I would say no. I'd have a range. Like, let's say, okay, if it goes down to 40,000, then I want to build it back up. Or if it goes above 65,000, then we can pull it back down. I like to have that range so then you don't feel like you need to hit the nail on the head every single day. But now we're talking about people that end up above that higher range of comfort level. And then you need to start having discussions and conversations, perhaps with someone like us, about where you should put your money next. I suggest doing an account audit, and I'm going to give you some examples of things where you may not be aware that you could put more money. Some examples. Maybe you are contributing to a health savings account, but only putting in the amount of money that your employer is providing as a contribution. Well, okay, let's put in more and get up to the max. That could be both a tax deduction, as well as you could get tax exempt growth and use that money in retirement for medical costs. Or if you're putting money in the health savings account and then you're writing checks out to your doctor's appointments, but your cash is piling up, why don't we turn that into an investing vehicle instead of a cash or savings account? Let's say that you have you work at University of Michigan, one of the largest employers that's near us. You're putting money to get your match, you're putting your 5% to get 10%. But what you may not realize is that you could put more money in. You could max out both in a 403B, 401A, as well as your 457 and get much higher contribution amounts than the original amount, oftentimes with a tax break as well. Maybe you have a 401k and you're just doing the match, but you are in a situation where you could use the tax advantage. You're making more money, so your taxes are higher. Then I would suggest that you consider or look to see if you could both either max out or even do after-tax contributions. We'll include in our show notes or our webinar notes a link to teach you about a mega backdoor Roth IRA, because that can be a way to get more Roth assets when you're over the income limit. So we would go through and say, okay, let's look at all your accounts because there may be some other places to shove money. But then for some people, and it just feels more complicated because there's less conversation about it and there's more choices and there are tax consequences. Then we often recommend to people, especially super savers, super investors, or people that want to retire earlier, let's talk about a taxable investment account. Sometimes those are called brokerage accounts. Their account titling may be in your individual name, in your joint name, or in the name of a living trust. And that's a great place to put money when you're saving more than you're allowed to put into your retirement account. It comes with some extra kind of levels of complexity because you do need to manage for taxes. You're paying those taxes over time. You're not paying the taxes when you retire. So we would and will in this conversation talk a little bit about how to be tax aware when you're investing in taxable accounts. And by the way, if you're one of those people, congratulations for being such a super saver. Don't make it feel like the danger zone. I think this is an opportunity zone, but it's one that just comes with a little bit more degree of difficulty. So one of the things I really believe in, and I don't think we talk about it enough, but I'm going to try to do a better job going forward, is that when you look at your investment accounts that share a common goal, the most common goal for people is often, hey, I'm investing so I can retire someday and maintain or even grow my quality of life in retirement, or my lifestyle. Then I really like the idea of looking at all of the accounts that have the common goal as a group. And too many times, accounts are just like one strategy and another strategy, and they're all kind of asynchronous and they're doing their own thing. The concept of looking at portfolios as a group, we call it householding. So instead of like each portfolio being a different room and having no context and not really feeling like they belong in the same house, we like to do all of your accounts together for a common goal. Together, added up, we like to have a mix of stocks and bonds that's the right fit for the purpose or goal. Let's say it's for retirement and you're a more aggressive investor. Maybe it's 80% stocks and 20% bonds, just throwing that out there. Or perhaps you're a little more moderate and it's 65% stocks and 35% bonds. But if you can put all of these together for their collective goal, then you have the opportunity for some extra tax strategies. You also aren't kind of doing a horse race and being sold to, like, I want to give you this strategy or that strategy. It's less of a kind of competing process and more of an aligned process. Why doesn't everybody do this? Well, in order to do it, it's really difficult to outsource your investments. So if you just say, hey, we have company X, Y, or Z doing the investments, it's more difficult to say and manage these three accounts that have different tax circumstances versus managing it in-house. You also need to invest in, if you're managing more than a few households or a few client accounts, you need to invest in software that can help you to keep track of the different rules and decisions that are involved with the level of complexity of managing multiple accounts. I know there's a lot of firms out there that do that, but I'd say that the vast majority do not. But we happen to really believe in that, and we've invested in both the infrastructure as well as built investment process and strategy that really honors the need for householding and builds portfolios. We call that portfolio construction in a way that would fit with that the idea of householding. Now, of course, if you have different accounts with different goals or different timeframes, so for example, college accounts, or maybe you have some money for purchasing a second home, and that's going to happen in 5 to 10 years, where you're retiring in 20 to 30 years, you may have a separate household or group or separate account with a separate, kind of target strategy. That totally makes sense. But when in doubt, if there's a common goal, we like to look at the money, regardless of which account it is in, as a group. We really think that adds to the right behavior and choices when it comes to investing and keeps you focused, again, on that bottom of the pyramid, the most important thing, your common goals. Okay, so I'm going to switch gears after we've talked about householding, but keep in mind, we think householding helps with some of the tax management strategies if done correctly. But I want to talk to you a little bit about taxes for taxable investments. So let's say you have an account or aspire to have an account, joint account, you own some ETFs and mutual funds. I just, I randomly decided on this case, another Google search, what was the biggest mutual fund in the year 2000? Because I just wanted to pick a fund that had been around, and if it was the biggest, that meant it was a pretty good fund back in the day. And Google answered, and it said, hey, Fidelity Magellan was the biggest fund in the year 2000. Great, that's a big fund. It has a growth bias, so I bet it's done pretty well over the last 10 years. I just talked about Fidelity and said it was the least expensive. Now I'm going to pick on it because we're talking about mutual funds versus indexes when it comes to tax costs. Okay, so in purple, this couldn't have turned out better. In purple, you have Fidelity Magellan. And over the last 10 years, you got a 229% return. In fact, beating the S&P. Way to go, Fidelity Magellan. But keep in mind in this example, you're an investor who is paying taxes as you go. Now, you may not be writing a check right out of Fidelity Magellan, But along the way, and I assume that you're in the highest tax bracket, you're somebody who's making a lot of money and then saving it into taxable accounts. Along the way, you're paying a tax bill. That tax bill comes from the dividends that pay out, the capital gains, distributions. It happens to be that mutual funds have like higher capital gain costs in some cases because of their structure and kind of the shared collective tax payment that all of the shareholders get. And so this is a look in my software over the 5 and 10 years for what the tax costs were for a fund like this. So Fidelity Magellan, over the last 5 years, beat the S&P 500. And in this case, I'm using Vanguard 500 ETF. So that's something that you could actually invest in. And the tax cost, though, for the highest tax bracket was 1.83% per year. You might not know and attribute this tax cost directly to, hey, Fidelity Magellan, don't cost me so much in taxes. But it comes out in your 1099 that you give to your CPA, and then you end up writing a check from somewhere else. Okay, so when you subtract from the returns that tax cost, the advantage that would have gone to Fidelity Magellan flips back to the exchange traded fund because they just don't carry as much tax costs. And in fact, the annualized 5 returns after tax are to the advantage of the ETF by about 1.5%. They're also cruising with a head start because of their costs, which are less. And over a 10-year period, they just very narrowly eke out in the ETF format versus the index, which had been a little bit lower. The ETF is slightly higher when it comes to the 10-year return, but not dramatically. But then you add in that tax cost, which is about 1.5% differential per year in terms of, checks you have to write to the IRS. And there's a dramatic difference in terms of the returns. So we don't have a crystal ball. We don't know all the tax costs, but we do know the structures that give us a better batting average of having a lower tax cost. And this really makes a difference in stocks, less so when it comes to bond exchange traded funds. But if you have portfolios that are being built with the more modern instruments that carry lower tax costs, ETFs, both if you're a more passive investment, you have an advantage, but also the structure of an exchange traded fund has its own advantages, then you are going up to bat with a higher batting average for reducing your tax costs over time, which we think is money in the pockets of investors. Okay, that's just one example, and I'm sorry, Fidelity Magellan, to pick on you, but here's some examples of tax strategies that really do work. And here's where investments are down, where you have unrealized losses. It's okay. We still have that long-term perspective. But if you move to a similar investment, selling one investment and moving to something similar but not the same, that can pick up a tax loss that can be used both in that current year if you have capital gains, as well as in future years. And so that's something that some portfolio managers do and some portfolio managers don't. We really like to put on that tax hat because we think that that is a clear and proven and quantifiable way to deliver value when it comes to the way that we invest accounts. The same goes for your cost basis election. It seems so simple, but not everybody is doing it. The standard format is called FIFO, first in, first out. If you bought something in 2000, you would sell that before you sold something that you bought in 2020. But the likelihood, hopefully, of something that you bought 20 years ago would be that it grew versus something you bought more recently would have had less time to grow. So that could be the most costly method of calculating your cost basis when you sell something, but that's often the most common. So there are easy forms to fill out, and sometimes they don't even need a signature, where you can choose either the highest cost or the minimum tax strategy that would calculate in a way that would automatically assume if you only sold a portion of your position and not all of it, that there would be a more likelihood that you would have less tax costs with that transaction. Asset location is a way to say when you're picking the rooms that you're investing in, that you put the things in that householding example, you're putting the things that cost the most tax-wise into the room that doesn't have tax costs. So what rooms don't have tax costs? Well, your retirement account rooms, whether they're Roth or traditional, you don't pay the taxes as you go. You pay it when you withdraw. So those are the rooms with the the higher tax costs. So let's say you're a portfolio manager and you just love Fidelity Magellan, you really want to own it. Great. In the householding example, you should put that into a Roth or IRA account and then put the lower cost in tax cost ETF into a taxable account. And you just created a situation where you don't have that tax drag that you would have if you carried both, or if you reversed which room they sat in. Managing turnover, if you just trade for the sake of trading, but it gets the same results and you're in a taxable account, that can create more costs than when you choose not to just, trade as much. Also your withdrawal strategy. So I've been talking a lot about where to put money when you're accumulating, when you're working, or receiving money. But when you start to retire and you start to use money, then choosing where you take that money in a way that is more technically preferable, where thoughtful, instead of just, saying, oh, each account will take 5%. Well, all accounts are not treated equal from year to year when it comes to your taxes. That is a huge driver of keeping money away from Uncle Sam and having more money in your hands to pay for retirement for retirees. And then if you have low tax years, this can be true for even people with a lot of money saved. If you're an early retiree, you're waiting till 70 to turn on Social Security, and you have a lot of taxable investments, you could even do Roth conversion strategies. We also work with a lot of people who are high net worth, who are divorced, but perhaps they're receiving spousal support or alimony, but that is coming from their spouse. And in current times, you do not have to pay taxes if you're receiving spousal support and it's a recent divorce. That's another example where, great, we'll do Roth conversions in the years before you start to use your retirement, and that'll reduce the taxes you pay and give you more money to spend over time. It's difficult to quantify the value of these things because everyone's situation is personal. But Vanguard tried to quantify the value, just not of financial planning, but just of different investment strategies. I think it's really powerful if you look at the middle of the screen. One of the things that's most powerful, and this is nothing more than that emoji chart when it comes right down to it, and being the poker face, but behavioral coaching, making decisions instead of just selling in March during COVID-19. If you call your advisor and talk through it and make a plan where you don't decide to sell, that can add huge value relative to your peers. But there's other strategies, for example, those tax conversations, spending strategy, being cost effective. All of these can be powerful in terms of adding to, but everybody's situation can be different. I've talked a lot, and I think a lot of these strategies could be implemented by anyone. Whether everyone feels like they want to make this their kind of job, managing their personal portfolio, well, that just depends. A lot of people get stressed, and managing your investments for taxes is even a higher hurdle rate in terms of how stressful and difficult it can feel for people. So I thought I would just lay out some reasons that people, who are told at the water cooler or by their parents and family, you should just do this yourself and save the money, when it makes sense to work with a professional. So sometimes it's because of bad outcomes. Maybe you're just someone who can't resist or feels, trapped by the fears that come with being a long-term investor. It can feel really scary and difficult. Or maybe you're listening to a lot of, Chicken Little, glass half empty, prognosticators. So if you've timed the markets in the past, you ended up in cash and you don't know how to get out. That's a great example of someone who should consider talking with a professional that would be a better fit. If you're somebody who's constantly chasing hot dot trends, you're buying meme stocks in 2020, Nvidia is half your portfolio today, although that's worked out so far. Past performance doesn't always predict future results. Segregating and having just a portion that's kind of the strategy du jour, and having a more solid research evidence driven investment strategy for the bulk of your portfolio, so you're not at the casino when it comes to your retirement funds, can be advisable. If you just lack organization, you're constantly finding, oh, I'm missing out because I forgot to invest that, or I don't even know what to do, or I'm just looking at what the returns were last year to choose the investments, and you don't know where to start. That's a great example where you may want to work with people. Or maybe it's just not your thing. You have imposter syndrome and feel really stressed. And I hear this from so many successful people. So you're not alone, even though people don't talk about this when they're doing their TikTok videos on how to invest, or, telling their friends on Facebook what to do. But so many people feel that they don't know enough. And working with a financial professional can both tell you where you're doing a great job, as well as uncover opportunities or pitfalls and address them. We work with a lot of families who are double income, Gen X. They've got kids that have needs. You think it's easy when it's going to get easier when the kids are little, and it just turns out that they have bigger challenges that you need to navigate and manage. Your careers are in full force, and hopefully you're having great opportunities to accumulate. But you also may have aging parents that you need to take care of, or relatives, and there's just not enough time to get the things done as you have added opportunity because of the complexity and success of your life. And, that's a prime example where having someone that can help you get things done means that you don't have things you knew you should have done, but didn't have the time left off the to-do list. And then also planning for aging. If you've always been a DIYer, but you can see the way, things kind of slowed down for your parents, planning in advance and having a game plan for who will manage things as you age and get older, or, with a spouse who may not be as dialed into investments, can be a good reason to bring in a professional. In many cases, though, we talk to people who do work with an investment professional, but I'm going to start from the bottom. Perhaps they are just getting investing advice, and when it comes to their retirement plan, it's like, yeah, you have enough, don't worry. But they don't really hear where they could start making their paychecks. They don't have the specifics of a financial plan that gives them confidence and comfort to understand how retirement's going to work. I think that's a big miss, because often they're paying as much or more than people that would receive a financial plan in conjunction with an investment strategy. And I really, as I said in the pyramid at the beginning, it's kind of Maslow's hierarchy of investment success. You need to tie those financial goals in your financial plan to your investing strategy and have them integrated, in my opinion. I'm biased because I'm a financial planner, in order to be successful. Perhaps you have a tax ignorant portfolio or a mismanaged portfolio, a portfolio that's old school. It looks like the way your parents bought it 20 years ago when you were a kid, or, you're just using the investor that your sister's friend or something like that. But you're not really getting thoughtful portfolio construction. You're not receiving proactive advice. Well, I think that, you do need proactive management when it comes to managing your investments. And if you pay taxes, you've got to have a tax aware portfolio for that portion that is exposed to taxes. And there are straightforward strategies, but they're not always, you can't just implement them in a day, especially if you're sitting with a portfolio that has a lot of tax costs. So we really want you to consider, do I need to make a change in those cases? Kudos if you're working with someone, we hope you are, that's really covering all of these bases. In that case, I hope this conversation has been a reinforcement that you've made a good decision in terms of how you're approaching things. In conclusion, I just want to remind you that the things that drive investment returns are not always what you see in investment headlines. It doesn't have to do with the election year or who's going to win. It doesn't necessarily have to do with even interest rates or opinions or forecasts or when the next recession is going to happen. Really, there are so many things that can be a distraction. Of course, they matter. Of course, you need to be informed if you're the investment professional like me. But when you focus on time and have a long-term perspective, when you focus on your behavior and have a process that helps you to succeed, when you're focusing on, it's not about picking the best stock, it's making good investment decisions of savings rate, et cetera. And then you have a mix of stocks and bonds that you can stick with, as well as a positive outlook for the long-term future. That really is what tips the scale toward an investor's success. It sounds simple, but it really drives results. And in so many cases, people are tipped toward that left-hand side of the equation and distracted from the things that really create success. They don't create the space and time for those bottom line big rocks that really make a difference. It's easy to think I'd rather beat the market. It's all about benchmarks and how do I make the most money. But when it comes down to it, what drives and thrives for a content, retirement or investing goals over time. One that makes sense for you in your life and one that's enduring and sustainable. I think achieving your goals is the number one target and goal. It's a benchmark of what you want to do in your life, and checking off that list that you're able to do it in conjunction with the work, in many cases, of a financial planner can really be fulfilling and reduce the stress and increase your options and increase your results. We've said a lot, and I want to make sure that you know that you can reach out to me. I realize I forgot to include my email address, but please don't hesitate to email me at melissa@pearlplan.com if you have any follow-up questions, or I'd just love to hear what you thought of our presentation and if you have suggestions for topics for the future, because we do webinars once a month and we love to talk about the things that people want to hear from us. This is directly out of conversations that we're having day to day with our clients. Don't hesitate to contact me with questions. I would also mention that in conjunction with our conversation, if you want an audit or a look at your investment accounts, we're happy to do it. We see hundreds of portfolios a year, thousands of portfolios over my investing career, and we're happy to take a look and give you some information and explanation about the things that are going on in your portfolio. So without further ado, I appreciate your listening and look forward to you tuning in again. Don't hesitate to follow the Pearl Planning YouTube channel so that you can stay tuned for future presentations, and have a great day.